Good afternoon and welcome to Scotia iTRADE's webinar. My name is Conleaf, the Client Education Specialist with Scotia iTRADE. I'm pleased to present to you today ETFs 102, Fixed Income ETFs with Horizons ETFs. So just before we get started, let's just take care of some quick housekeeping items and then we'll jump right in. So your sound quality should be good. You can check this sound quality by clicking on the sound check link that you see on the audio panel of your GoToWebinar toolbar. So this setup window may be on your secondary screen if you're using two monitors. In addition, please be reminded that everyone will be muted for sound quality purposes today. Now, if you're using your computer audio and you are experiencing any sound quality issues, you could always call in on your telephone by using the telephone number you see on your GoToWebinar panel. In addition, just don't forget to use the access code and the audio pin, which are also shown on your GoToWebinar toolbar. Now, as a quick reminder, unless otherwise, expressly stated by Scotia iTRADE, seminars, webinars, and other educational tools and resources, which is collectively called content, are provided by independent third parties and are not affiliated with Scotia Capital Inc. or any of its affiliates. Scotia Capital Inc. and its affiliates don't endorse or approve, nor are they liable for any third-party products or services, third-party content, or investment loss arising from any use of the content, which includes the third-party content. So just as we go through the presentation, keep in mind it's primarily for educational and informational purposes only. So let's take a look quick now at the toolbar that you see here. We'll quickly review those. The orange arrow that you see at the top can be used to minimize or to maximize the screen. In addition, you can view this presentation in full screen mode by clicking on the computer icon there on the GoToWebinar toolbar. Additionally, you can always use the hand icon to notify if you've got a concern or a question. However, we find it's easier to more convenient to use the question panel box. If you've got a question, just type it in. I'll be monitoring those and interacting with you directly as we go through the presentation. There will be a Q&A session as well, so if there is an in-depth question, the presenter may elect to reserve it for that Q&A session afterwards. So today's session will be recorded. Now, an email is typically sent out within one business day of the presentation. However, I'll have to do that manually for the time being until we've clarified the rulings around the castle situation. So if you don't get the presentation, please feel free to email me at education@scotiaitrade.com. I'll include this a little bit later on if in fact you do not get that email link to the recording by tomorrow. The other point is you can always visit our YouTube channel. We've got webinars on our on-demand playlist on our YouTube. Our YouTube link is located at the bottom of our scotiaitrade.com website. You'll see the link there, the small YouTube link. Just click on that to view the list of our recorded archived webinars. Today's presentation has been downloaded for you, so you can just go to the handout menu in your GoToWebinar toolbar, click on the hyperlink handout, and then you'll be able to follow along in the handout, make notes if you'd like on that handout as well. And then, of course, tomorrow when you receive the recorded link, you can follow up on both the recording as well as the handout. So today's session is a part of Horizons ETFs Learning Series. ETFs 102 Fixed Income ETFs is the second part in the series, which is a three-part series covering different aspects of ETF investing. So today will be ETFs 102 Fixed Income ETFs, and I hope you'll enjoy it. Our presenter today is Mark Noble. Mark is the head of sales strategy, VP Communications and Public Relations. He's been with Horizons for more than 7 years and is responsible for its external communications and sales strategy. Mark is a strong proponent of financial literacy and ETF education. He works closely with Horizons sales and marketing teams to build out the client education tools and initiatives that help us as Canadians become better ETF investors. Prior to working with ETFs, Horizons ETFs, Mark was a personal finance journalist at the Advisor Group a leading financial publications service that provides investment information to the Canadian market. So I would like to now welcome Mark to the presentation. He'll take over and facilitate us going forward. Let me see. Okay, Mark is not here as yet. Let me just take a quick look and find out what's happening. Should be here now. Just bear with me a quick moment. They may be having some technical issues there logging on. So if you'd like to bear with me for one moment, I'm going to contact Mark. Thank you so much. I apologize for the delay. Hi all, I am trying to contact Mark Noble over at Horizons. I do apologize for this. We should be able to get him on in just a moment. Thank you so much for your patience. Hello, I appreciate that, Raf. I can definitely understand your concerns and frustrations. So I found out that Mark is available, but is awaiting a link. I will send that link to him and be able to get him on in just one moment. Do apologize. Another 2 more seconds and we'll be good. Do apologize. Okay, great. Mark is now available and is in the midst of logging on and should be able to be with us in one moment. Do apologize once again.
Hello?
Hey, Mark, you there?
Yeah, my sincere apologies. We've had some serious technical issues on my end. I'm on now, so thank you for everyone's patience. Sorry about that.
Thank you, Mark.
Would you like me to just get started, Conleaf?
Yeah, please go ahead, Mark. I've set it up.
Yeah,
Everything's good to go.
and you can just share
Thank
the
you.
screen. Yep,
Yep, screen shared.
thank you.
Welcome.
Hello, everyone. Thank you again for your patience. I know it's not easy to wait that long for something. I just was having a lot of trouble getting my computer to sign on to this network and a number of other issues. But we're good now, and we're here now, so I'm happy to get started. I'm just waiting for the screen share here, and we'll go from there.
Okay, you should be good to go there, Mark. Do you see it now?
Perfect. Thank you.
Excellent.
And the good news is this is not as long a presentation as we normally do, so we should easily get finished before the end of the hour. And just going to put on full view here. Okay, perfect. So today's topic is income investing using ETFs, and this is probably one of the more interesting topics on our suite of educational series that we do for Scotia, and that's because the ETF market, when it comes to fixed income ETFs, is a very unique market, particularly in Canada, and it's an area where I find I get a lot of questions, not just from investors that are new to ETFs, but also investors that have been trading ETFs for a long time. The fixed income space adds a few wrinkles to the investment process, which necessitates having sort of an educational process where we can talk about, the ways to effectively invest in ETFs to get your fixed income exposure. So the agenda for today's presentation is one, we're going to look at the new realities of fixed income investing, and this is just talking quickly about the fact that being an income investor has probably never been as difficult as it is today. We're going to talk about the impact of fees. One of the things that drives fixed income ETF use in Canada is the low cost. And then we'll talk about how to use ETFs to get income exposure, and then some of the advantages of active management and some ETF strategies for a rising rate environment, which we find ourselves in today and probably over the next year or so. So one of the interesting things about fixed income is that while people talk a lot about interest rates and yields and all these different ways to generate an income in your portfolio, we have one static shift in the Canadian marketplace and the North American marketplace, really, that necessitates a longer and bigger discussion about fixed income. Regardless of what's happening in the market and what's happening in terms of federal policy decisions and Fed bank decisions, there is an undeniable fact that a larger swath of Canadians are getting older. And as you get older, you have a higher degree of need for income, regardless of whether you have a longer time horizon. Now, the reason that there's so many more people that are going to be elderly, not elderly, I'm just going to say skew older, is because people are living longer because of advancements in healthcare. Obviously, the boomers, which is one of the largest generational shifts ever in human recorded history, are now all sort of tipping around 60, even to 70. 1946 sort of that started. So we have a large swath of boomers now entering their 70s, so well into retirement or near retirement, and have it therefore a need for income. And we can see on this chart, which is from 5 years ago, but the trend still holds, that in 2011, roughly less than 10% of the population was 65 or over. We expect by 2021, I think we're well on pace for that about 15% of the population will be 65 and over. And of course, by 2031, or roughly 15 years from now, you're looking at roughly 20%, 1 out of 5 Canadians being 65 or over. And therefore, there is an undeniable need for income, which will likely mean that yields and other types of drivers of growth for income will likely be depressed. You're likely looking at a lower yielding environment for the next couple decades due to the overwhelming number of people that are going to be needing a higher degree of income for their portfolios. But the issue then is what we call the income challenge. And so if you're looking at a portfolio where you're trying to generate a higher amount of income in your portfolio, it's a lot more difficult than it was 2 or 3 decades ago. If we go back to 1994 even, which was sort of the last time we saw interest rates rise, yields were probably somewhere in the 8 to 9% range. Now, if you think of that in context to where they are today on a similar type of government bond, where they're sort of in the 1 to 2% range, you were generating anywhere from 6 to 8 times the amount of yield that could be generated with basically risk-free investment. Today, the idea of generating income, whether it's through a GIC, bonds, or preferred shares or dividends, is that yields are lower. So historically, bonds and fixed income securities have been viewed as lower risk compared to equities, but that low risk yield is probably the lowest it's been in any of our lifetimes. On the other side, you've got other ways to generate returns, which you can do through equities, but but that comes with a higher risk, and of course valuations today are very stretched. So you've got a conundrum here as an income investor. You need to have a higher degree of income generated for your portfolio. If you choose to do it from a fixed income side, and when I'm talking about fixed income, I'd be referring to bonds or GICs, you're looking at very low yields and low returns. And if you choose to do it on the equity side, which are things like dividend paying stocks, you're taking on a lot of equity valuation risk. I mean, valuations on Canadian and US equities are the highest they have been in roughly 15 years. You really have to go back to the early 2000s and the dot-com bubble to see the kind of valuations that we see today. So it's kind of a damned if you do, damned if you don't kind of situation where you've got this low yield and you've got these potentially higher volatile returns. And this has created a real challenge for investors who have a real need for income. If you are a retiree or near retiree, the ability for you to take on more equity risk, even if your life expectancy is well into your 90s, it's lower than it was when you were in your 40s. That's just a fact of the demographic challenge. You've got to have most people are using their portfolio in retirement to pay for things, which means you need a certain amount of drawdown. So this is what we've called the income challenge, and it's something that really challenges both direct investors like yourselves as well as financial professionals that work with investors. Fortunately, ETFs have really helped mitigate some of this income challenge by offering sort of flexible ways for you to get exposure to key investment asset classes. So very quickly, we will go over some of the basics of ETFs, but an ETF is an open-end investment fund similar to a mutual fund, in that new units can always be created, and most importantly, the value of those units reflect the underlying value of the securities held in the fund. They're listed and traded on an exchange and trade just like a stock, so you can find those ETFs on your Scotia iTRADE platform, which we'll go through a little bit later in the presentation, and be able to follow them on a daily basis. So just like a stock, you can track them and do all kinds of technical analysis and all sorts of neat ways to follow those. And historically, they tend to, especially the fixed income side, tend to track a passive index or a benchmark. So they tend to be low cost, providing sort of the broad aggregate return of a fixed income benchmark. So very quickly, most of you are probably familiar with mutual funds. When a mutual fund works, it's a fairly simple process. You as a buyer, you go to the fund company and you put in an order for a fixed income fund. Maybe it's preferred shares, maybe it's bonds, and the fund company goes to the market, creates new units of that fund, and they give you the end of day net asset value, which is the aggregate value of that fund available for you to purchase. ETF works just a slightly bit different. It provides the same benefit, that is, you're getting this what we call open-ended structure, so that the value of your ETF is always reflective of the underlying value of securities it holds, except that you as an investor are actually going to the market to buy that ETF similar to you would as stock. So we call that area, and I'm just going to pull up my highlighter tool here. We call that area here the secondary market. So this is a secondary market. So here you're buying it from institutional investors, and they're the ones who are creating the ETF units and then listing them on the exchange. This change in structure allows for the ETF to be listed on the exchange similar to a stock. So again, very similar. If we go back one slide here, if we go back, we see that this is how the mutual fund works. It's the same process. At the end of the day, your fund is reflective of the underlying value of the holdings. With the ETF, it's reflective of the underlying value of your holdings. It's just the process by which the exchange-traded fund is bought and sold is a little bit different. And that's the new technology of what ETFs is. Actually a made-in-Canada invention, celebrating 150 years of Canada. It's actually was listed as one of the unique Canadian inventions. The exchange-traded fund was invented in Canada in 1990 to track the 30 largest stocks in Canada. That was the first ETF. It was called the TIPS 30. And since then, we've now seen over $4 trillion now invested globally in ETFs. So a real Canadian success story. Now, what I want to highlight is most of you are probably familiar with how ETFs work in terms of equities or stocks. And that's fairly straightforward. Most ETFs hold most equity ETFs very simply hold a index of stocks, which could be something like the S&P TSX 60 or the S&P 500, which are the largest 500 US stocks, and they hold them in relation to their value. There's all kinds of different ways to weight those stocks, but it holds those stocks. Bonds are held similarly. A bond ETF would hold a whole list of bonds. Maybe it's an index, maybe it's an active strategy. What I want to highlight, though, is that bonds and equities trade differently. So ETFs themselves don't trade differently. An equity ETF and a bond ETF trade effectively the same, but the underlying securities that they hold trade differently. And the big difference here is that bonds trade what we call over-the-counter. That is, they're not listed on a transparent way on a stock exchange. Which means that their price discovery, and when I'm talking about price discovery, I'm using some jargon there, but their price discovery, that means the ability to value them, isn't as well known to the larger group of investors because they're not trading on the secondary market on an exchange. They're trading directly over the counter through a dealer to someone buying from a dealer. And typically, or historically, fees and pricings on bonds have not been transparent. So even if you were using a brokerage account to buy a bond, what would end up happening is the commission that the bond traders would make historically would be built into the yield. So if the bond was yielding 5%, that bond trader may take 1% off, so you get a bond that yields 4%, and not realizing that you've paid a significant commission to bond traders. And there used to be a joke in Bay Street, that good equity traders drive BMWs and good bond traders drive Ferraris. And that is because of how much money could be made on the commissions of bonds because of the inability for this price discovery, and this closed dealer network allowed for bonds to be a very lucrative trade for people. And so the liquidity of bonds is therefore reliant on the dealer's available inventory. That is, these dealers, what they have available to sell, and that creates a lower amount of liquidity than you would see on equities. And also, bond indices, therefore, are weighted not so much on market capitalization. And when I'm talking about market capitalization, I'm talking about jargon again. What I mean, the size of the company, they're based on the amount of outstanding debt. So if you have a stock index like the S&P 500, the largest stock is Apple because that's the largest stock in the United States. In the S&P TSX 60, the largest stock is Royal Bank because that's the largest stock in the Canadian market. If I move to something like bonds, the largest bond might be something like Sprint, which it's a high yield bond, and that's certainly not the largest stock or even the most healthy company. So its amount on the outstanding debt. So that really changes the way that the indices that many bond ETFs track is very different. So these are really the key changes here. These are non-transparent market, and they're weighted based on outstanding debt. Now, the real advantage of ETFs is that ETFs have created price discovery for bonds. So where in the past buying a bond was a very expensive proposition, an ETF is working fairly like a large institutional investor. So an ETF that has hundreds of millions or maybe even $1 billion in it goes to the market, it gets a real-time low pricing on the bonds that it purchases, and therefore the value of that ETF is reflected on the secondary market forces. Bond ETFs, in effect, create bond trading in the secondary market, which creates price discovery, which creates a transparent, low-cost way to buy bonds. And this will probably be of no surprise to people on this call, but in Canada, which has not a very liquid corporate bond market, and has been a historically expensive bond market, we have the highest penetration of fixed income and bond ETFs in the developed world. Roughly 30% of the ETFs in Canada are bond or fixed income ETFs. That's almost double the global average, and that's because for Canadian investors that have been historically had to pay a lot for bonds, we pay a lot for cell phones and bonds. We still pay a lot for cell phones, but ETFs have really leveled the playing field for investors of all levels to get exposure to bonds through ETFs. So a lot of people are probably surprised to know that $1 out of every $3 invested in ETFs in Canada is invested in bond ETFs, and over the last couple of years, almost $1 out of every $2 going in the ETF business has been going into bond ETFs. Now, this is a US example, but again, I just want to show again the difference between a stock and a bond index. A stock index, very simply, holds the largest companies, and this would be on the, I'm going to pull up my highlight tool here just to make it a little bit easier, but this would be the market capitalization weighted of the different stocks here. And on this side here, we can see though that while Apple is the largest company in the S&P 500, we see that Anheuser-Busch is basically the largest holding on the largest corporate bond index in the United States. So very different, right? If we look here, we have GE, a number of lines of Anheuser, there's Goldman Sachs, none of the same companies here, right? Because these companies actually probably have fairly low debt loads. They have high cash, amount of cash. These are large companies. These are companies that can service a lot of debt. So something to keep in mind, very different when we're talking about a stock and bond index. May not always want to own the company that has the most amount of debt. Anheuser-Busch, through all its consolidation of owning pretty much the entire beer industry, they've taken on a lot of debt, whereas Apple probably looks better from a balance sheet perspective. So something to keep in mind there when you're talking about key differences between bond index ETFs. Now, bond index ETFs, though, what they do is they offer a transparent way for you to get a valuation of the bonds, and that's obviously a great benefit to most fixed income investors. Now, I like to call this the credit ladder, and the reason I like to use this is just to give you a sense of the risk and yield that's out there. So when people are, the financial services and the investment management industry is a very sales and marketed focused industry where they tend to come to market and try to, sell all kinds of different ways for you to generate higher income in your portfolio. As a general rule, the higher the yield of a security, the higher the risk. There's no free lunch in investing. So if someone's offering you a higher yield, it almost always comes with a caveat of the fact that you're taking on some higher amount of risk. And most of the risk that's built into the yield that fixed income securities pay is built into the underlying risk of that asset class. So you're being compensated to take on more risk with the yield. And so generally speaking, when we're looking at a credit ladder, we're talking about something called credit risk. Now, there's really two key risks in fixed income investing. There's credit risk, which is the likelihood that the underlying security will pay you back the debt and therefore won't default. And there's interest rate risk, which is the fact that as interest rates rise, bond valuations decline. So those are the two key risks, and the big one being credit risk. And so just want to make sure everyone's on the same page here. As we look at things that yield higher and lower risk, generally the hierarchy of risk goes like this. Government debt, when we're talking about Canada and US bonds in particular, because these are large developed nations, you're basically looking at virtually no credit risk, right? The debt of the Canadian government or the US government is fairly absolute to pay you back the debt. Then we look at corporate bonds, which we'll be referring to as investment grade corporate bonds. Again, these are large corporations, think Royal Banks of the world, that again have a very, very high likelihood of paying you back. Now, because they have a higher likelihood of paying you back, they yield less. So the lower the risk, the lower the yield. Then it stands to reason that the higher the risk, the higher yield. And that's where you look at things like senior loans and high yield bonds, dividend paying stocks, and covered call writing, okay? And these are all very popular asset classes right now, these top three, because they're generating higher yields. But I do want to highlight that that comes with a higher amount of credit risk, a higher likelihood that these particular asset classes may not pay back their debt. Although in the case of all of this stuff, the risk is at historical lows, but there is a hierarchy of risk, and that comes with the yield. So just highlighting again the type of fixed income ETFs. At the high end, when we're talking about bonds, we're talking about high yield bonds. A lot of products I'm finding are increasing their holdings of high yield bonds because they yield more. When we're talking about high yield bonds, we're talking about a bond that's technically rated BB or below, and is considered non-investment grade. Now, there's a lot of well-known names that have high-yield bonds. For example, Tim Hortons is a senior loan, which is a type of high-yield bond, and that's because of a large acquisition that occurred with 3G Capital and Burger King buying them. So Heinz Ketchup is another one. So again, you have some well-known companies that are high-yield bonds. It's just that the amount of debt on their portfolio necessitates a higher risk rating, and it comes with a higher yield. After high-yield bonds, we have senior loans. This is something you may or may not be familiar with. It has other names such as floating rate or leveraged loans. And basically, these are also non-investment grade bonds, but unlike high-yield bonds, they're higher up on the spectrum than regular corporate debt, so you get paid back sooner, and they pay a floating interest rate. So they pay an interest rate which is derived as a spread over LIBOR, which is the base interest rate that banks pay each other in the US. So you get a floating yield, which means that they virtually have no interest rate risk. They only have credit risk. So that makes them safer than high yield bonds, but they're still non-investment grade bonds. We have investment grade corporate bonds, and we have government bonds, which are the government issued securities. So this is sort of a rehash of the previous slide, just going into a little bit more detail, particularly if you want to revisit this. And here, if we go back here, we see that what we call the credit spread. And again, this is me using jargon, but it's something that you'd hear on BNN. I'm talking about credit spread. What we're talking about is that generally this is the kind of yield you can expect over the different groups. So this AAA curve would be high investment grade corporate bonds and government bonds. We can see that on this light blue line, they sort of tend to yield in and around 1 to 2%. And if I look at this dark blue line, which is double B, we see that they yield more in the 5% plus range, okay, or coming down to the 4% plus range. B is probably up over 5%. So there's your differential of what you're being compensated historically to be in these different levels of bonds. So you, again, just showing you very specifically, you're compensated more to own the higher yielding instruments, but they come with a higher risk, and that's called the credit spread. Now, one of the reasons that Canadian investors have moved so strongly towards fixed income ETFs is because of the impact of higher management fees. Now, we've moved into an environment where yields have compressed dramatically, and as a result, that means that on a fixed income product where most of the return is the income, fees make a huge difference. So if your fixed income ETF or fund in general is yielding about 3%, and you're paying over 1.5% to get exposure, which historically was sort of what it cost to buy a bond fund in Canada, you're losing half your yield in fees. So it stands to reason, again, that the big rush towards bond ETFs, a lot of it has to do with these lower fees in a fixed income. You know, sometimes people don't mind paying 1.5% for an equity product that's going to generate an 18% return. Like we've seen with U.S. equities or Canadian equities last year. That's not going to happen with fixed income. They're low yielding. Maybe they get some momentum from a declining interest rate environment, although those years are probably behind us. And so you're really banking on that yield. And if you're getting only a 4% annual return, like I use in this example here, you're looking at a significant loss due to fees. So we can see here very simply that if I bought $100,000 in two funds that invest in the same group of bonds, and one was 1.6 and one was 0.5, and 0.5 is actually expensive on the ETF side, you can see here that you have a difference after just 10 years of roughly $14,000 or 14% per year. So a significant amount of money that's lost to fees. And again, these are the same price returns, so all you're doing is you're basically throwing away additional money by paying for the higher fee product. And that's typically what we've seen in fixed income ETFs versus higher fee mutual funds or buying individual bonds at a higher commission. It has an even greater impact in the drawdown phase. So if we take this same example now, and now we decide that this person is going to take $10,000 each year from their $100,000 portfolio to pay for expenses in retirement, we see obviously you're working with far less money to draw down from, and the amount of compounding that you get for your portfolio over that period, over the next little while, magnifies. So the next 10 years, you would see a differential of about 33,000 on the same two funds as you go into the drawdown phase. And that, again, has to do with compounding, because if I'm paying less up in this area, I'm actually having a higher amount of principal that allows me to save more principal to compound that 4% per year. Whereas this one, the higher drawdown with fees, creates a much lower return. So very, very crucial that when it comes to fixed income, fees are one of the single most important aspects of choosing a fixed income strategy. The other risk that I talked about, again, is interest rates. And again, this is just reframing this income challenge debate, which is this, that we've been blessed to be in a 36-year bull market in bonds, which really effectively ended in the last fall. So we can see here both on the US side, and now we're seeing it in Canada, where the Bank of Canada just raised interest rates. We're finally seeing a rising interest rate environment just on this blip dip here for the first time in, well, since 1994, and really it's part of a reversal of a 36-year trend. So from a generational perspective, pretty much nobody on this call has, unless you were buying GICs in 1982 and holding those for a long period of time, everyone's benefited from a bond environment where bond prices have continuously gone up and yields have declined. So it's really been there's been no risk to owning bonds. But that changes dramatically as we move into an interest rate environment. So this is a brand new era, a generational change really that we're seeing right now, where we're, for the first time in many, many years, since the 1980s, we're in an environment where investors could lose substantial amount of money on bonds, on safe bonds. I'm talking about investment grade government bonds due to rising interest rates. And in fact, over the last 3 months, government bonds in Canada have lost about 3.5%, so more than a year's worth of yield over the last 3 months as interest rates have risen. Again, when something yields 3% and loses 3.5%, you're now negative. So this is uncharted territory for a lot of fixed income investors who are relying on this to be sort of the core of their fixed income portfolio. Again, I'm just going to explain how this works, but we have something called duration risk, and the way that duration risk works is we see that we see here that a 1% rise in yield basically results in a 1% loss on the value of a bond, regardless of what type of bond it is, assuming that it pays a fixed coupon and doesn't have a floating coupon. So in 1990, Canadian 10-year bond was yielding about 10.5%. So if I saw a 1% rise in yield, that roughly resulted in about a, with a duration of 10 years, you lost, right, about 10%. But because you were earning 10.5% on the coupon, you still had a positive return. That was the benefit of the high yield. It offsetted that, what we call duration risk, 10 years. Now, if I take the same bond in 2016, or this really applies to 2017, but the yield's gone up a little bit, the duration is about the same, we see that a 10-year bond with a 1.5% yield, now if interest rates rise 1%, I'm going to lose 10% on that bond, because you lose 1% of return for every year of duration. So now that same 10-year bond, which was risk-free from a credit perspective, but highly interest rate sensitive, I now see that I earn 1.5%, so I have a 1.5% yield. But now my 1.5% only offsets less than 15% of the total return, and I end up with a negative 8.5% loss owning the same bond, because low interest rates but still the same duration means you have that much more risk. So the high yields of the past offset the risk of owning bonds. The low yields now and rising interest rates creates what I call a perfect storm to have significant losses in a bond portfolio. And this is really the single biggest risk fixed income investors probably in Canada face over the next year or two. There will become a time where rates might stay flat, but losing 3 to 5% in your bond portfolio in a world where they're only yielding 3%, these are significant losses and definitely hurt the end retirement goal for many investors. So keep that in mind, and if I have one thing I want to talk to you about today, it's that when you're buying your bonds now, you need to be looking not just at the yield, but you need to be looking on your bond ETFs at the duration as well, and trying to find products that have, you know, a good mixture of lower duration and attractive yield, rather than buying things that have a higher yield that comes with a higher duration. And you'll see that most bond ETFs in Canada have durations that are higher than their yield, which means they have a built-in risk if interest rates are supposed to rise. Now we're going to talk a little bit about buying and selling ETFs, and this is something that's very important to understand when we're looking at buying or selling a bond ETF, is that when you're buying an ETF, again, you're placing your order anytime throughout the day, and it's you know, filled almost immediately on the brokerage account, whereas in the mutual fund, it's only bought at the end of the day, so you don't need to worry about market activity or the cost of buying those ETF. So that's, you know, a big difference between that, but that provides the intraday liquidity and the transparent pricing for you to get in and out at a value that's reflective of the underlying value of the bonds. Now the way that, very simply, that this works is that each ETF provider in Canada has what we call a market maker, and these market makers are what we call the pillar of the ETF ecosystem. They're ensuring that the ETFs trade very close to the net asset value of the ETF and provide a fair pricing. And I'm going to show you exactly how this works by looking at the bond ETF portal here on the Scotia account. So I've got a account here put in. But the way that it works is, what you want to do when you're looking at a bond ETF is, and I highly recommend you do this first, is you'll want to look at the quotes and research page here on Scotia, so this bar up here, and click on that, and we'll put in a bond ETF here. Just a second. Let me reload in. And we're going to put in a large-scale bond ETF. We're going to do HBB, which is just the Horizons Canadian Select Universe Bond ETF. This gives you exposure to the broad Canadian bond universe. And there's some key things here to look at before we even look to put in an order. First, we want to know what the underlying, actually I'm going to use another ETF that provides a yield. We want to know what the underlying yield of the ETF is. So in this case, it's listed as a dividend yield, but it's not actually a dividend yield. It's the income yield that you would expect to earn on a monthly or quarterly basis. And we can see the current yield of this product is 2.77. Most Canadian investors have a target return of about 4% on their drawdown. And so you'd want to be looking at roughly something that meets, I'm not saying you're targeting something that's 4%, but if you're going to buy an ETF like this, which is high investment grade, so very low credit risk, you're probably going to want to offset that with some things that yield a higher amount. And we can see here the star ratings of this ETF and the management fees, which are quite low. In fact, they've come down, I think, to 0.9 now on this particular ETF. And what I really like as well is that you can actually look at the top performing Canadian fixed income ETFs that are in this category as well. So it's not just Horizons here. You can see a number of other products that have positive markets over the last 3 months, and giving you a good sense, obviously in a rising interest rate environment, of what's been doing well. You know, top of that is the Horizons Active Canadian Bond ETF. You have all of this information amazingly put together at your disposal for iShares, and you want to, on iTRADE, and you want to make sure you're looking at these things before you make an investment decision. And look at some of these competitors and compare what they're doing, and maybe even going to their websites and looking at the duration difference between them. Some of these products probably have shorter and longer durations, which may or may not work in your favor. Now I'm going to put in the HYI, which is the Horizons Active High Yield Bond ETF. And it's a high yield bond ETF. And we can see here now when I look at the dividend yield, I'm looking at 5.38%. And again, a much higher yield, but my credit quality down here is a B, so we can see that it's a lower credit quality. Whereas on the previous profile, if I went down there, I could see the credit quality was nothing, and I can see the duration was 7.57. So a lot of interest rate risk with this ETF. And with this ETF here, I have a higher yield and a lot of credit risk, but not as much duration risk. So again, I can look at competitors to this and see what's doing quite well. And this is all a great litany of information for you to look at before you purchase the ETF. The final piece I want you to take a look at on your profile overview is to look at the difference between the bid and the ask. So this is basically your cost of acquisition to buy that ETF, the commission that you're going to, on top of the commission that you pay. The market makers that I referred to basically take this as the cost for acquiring the bond. So for something like high yield bonds, which are fairly difficult actually to access in a liquid manner, they're going to charge you roughly 2 cents. The ask is what they're going to charge you, and the bid is what they're willing to pay. So in between that is roughly what we know would be the real market value. So if I see 22 and 24, that probably means the market value is probably in around 10.23, and you're paying roughly 1 to 2 cents to access that. The other thing you want to look at, again, is always look at what we call level 2 quotes and see the amount of shares that are available at the different pricing. So what we can see here with HYI is that there's 2,000 shares that are available at 10.24, sorry, 8,000 shares. But if I move beyond 8,000 shares, I don't know who'd be buying more than 8,000 shares. That's quite a bit of money already. We're looking at over $80,000. But you're looking, if you're moving up into the hundreds of thousands or $1 million range, you're probably going to blow through that, and then you'll start being charged a higher amount of bid-ask spread, a higher price to move beyond that. Although typically what happens is that if a large order comes in at 10.24, the market makers who make money on the 2 cent commission, they can very quickly, using high level algorithmic computer trading, come in to meet even more orders. But it's important to look at the depth of order to see just if you were to execute right now, what would be available for you, although I would expect that whoever's offering at 10.24 probably comes in with even more volume at 10.24 because they're happy to sell that to you. It is like very much a simulated auction system. When you go to actually trade then, what you want to do is we're going to put in the same ETF, HYI, which was yielding that attractive 5.8% yield that we liked. We're going to put in a buy order, but what we want to do, and I'm just going to say it's 8,000, which was sort of what was a good order size. What we want to do is we want to put in what we call a market order, okay? Always with ETFs, you want to use a market order. That's the single biggest way to protect your cost when you're going, when you're putting in an ETF order. It ensures that the price is executed that you want to pay, not what the market want to pay. Now, I want to highlight that the price could move beyond the 10.22 or 10.24, but I saw there that roughly around 10.25, 10.24 is what I want to pay, so I would put in the price at the 10.25 that I wanted to pay for the term of the day, and then I would preview that order. So always with ETFs, without hesitation, my one piece of advice, and it's very important, always use this market order function, both on sales and purchases of fixed income ETFs. So that's a very easy way that you can use the quotes research and trade on the Scotia iTRADE platform to really maximize the performance of your fixed income portfolio. With that, we're going to run it. We're sort of running out of time, so I'm going to make up for that in terms of just moving forward on the presentation and ending it there to allow for some questions. But that's really the basics of fixed income ETF investing in Canada. I sort of gave you the 35-minute overview, and I apologize for the truncated time, but I think we covered all the key essentials there. And always, if you have any questions, I not only work through Scotia iTrade, they usually get in touch with me with any questions, but you can contact us directly at Horizons ETFs at the following contact details. We'd love hearing from end investors, and I'm happy to, even myself sometimes, go out and answer any questions that you may have. So with that, I'll pass it over to Conleaf and see if there's any questions that the audience may have.
Great, thank you so much, Mark. At this point, there were no additional questions. However, should you feel okay, you guys can just type in your questions, and I will forward those to Mark. So what we can do then is we can move to the wrapping up. Okay, here was a question from Leah. How do you sift through available ETFs to find those to purchase?
Great question. If you don't mind, guys, I'm going to go back to the Scotia iTrade platform because I think for you guys this is probably the easiest way to do that. What you want to do is probably look at broad bond ETFs first. So you want to look at investment grade bond ETFs. I'm going to use the example of HBB, which is our broad bond ETF. And what occurs is if you look over here, I can see that this is, I know this is a high investment grade, so this is low credit risk. This is sort of the large swath of investment grade bonds in Canada. So getting one shot, getting access to 100+ bonds, or some cases over 800 bonds. So really aggregate performance of the Canadian investment grade bond universe. And what I would do is I would take that and then I would compare this bond ETF with its fees, which are quite low, and and its performance, and I would look at it versus other bonds in the same category. So one of the nice things Scotia does is it has the top and bottom performing Canadian fixed income ETFs, and this is a great way to look at this. Let's look at multiple ETFs before we make a decision. So I can see here that these are some of the top performers. So let's pick VGV, for example, which is Vanguard, and I can compare what that is, and I can see that VGV offers me a 2.51% yield and a AA, which is very high investment grade, and a very low management fee of 0.25. So I would probably take that and note those key features. And then I would look at MKB. And here I can see that, you know, you have again the performance head outlined for you, but now you also have a yield here that's much lower, 2.4, and a much higher management fee. I don't know if I would purchase this one versus the other one, but looking at it directly, so I'd want to look more into what the selection criteria for this ETF is. My suspicion is this is an actively managed ETF, but I can see that it yields lower. So these are the key things you want to look for. Number one is this area here, which is fees. Number two is yield. And then number three is the credit quality and the duration, if provided. They're not always provided. And then, if those things are attractive, look what the actual ETF profile is. Maybe you like the idea of a large asset manager buying the bonds for you. There's certainly advantages in the Canadian marketplace to active management, and that shows in the performance. So that's a great way for you to start. I would look at a short list of 5 to 6 ETFs before you make a purchase of one ETF, and do that research so you feel really comfortable about your decision. I hope that helps answer your question.
Great. Thank you, Mark. I have another question here from Raf. Does the price of the actual ETF go up and down like a stock?
It does. Yes, it does. And that's reflective of the underlying value of the underlying bonds that it holds. So if those bonds go up in value, an aggregate, if they have a positive, so if I take 100 bonds and an aggregate they have a, let's say, a price move of up to 1%, the value of the ETF would increase 1%. So absolutely, same as stocks. If I hold the 60 largest stocks in Canada and they increase in value, my ETF increases in value lockstep with the aggregate performance. Of course, some bonds in the portfolio may decline, some may increase. You're looking at what we call the net asset value, meaning the aggregate asset price growth of the underlying to create your price for the ETF.
Beautiful. Thank you so much. And one last question now from Alan. Is board lot same as for stocks?
Yes, it tends to be actually. So you'll have to look at what they are, but I do believe they're sort of in the, correct me if I'm wrong, but I do believe they're sort of in the 250,000, 25,000 unit valuation. Sometimes they're determined on the dealer. They may be set by price. They may be set by units. That's something that you would probably have to look into.
Great. Thank you, Mark.
Yeah.
So those are the questions that we had so far. We've gotten to the 2 o'clock mark. We're quite close to the 2 o'clock mark. So we're going to move to the wrap-up and stuff. I really appreciate the presentation, Mark. And to all of you, we just want to apologize again for the technical glitches we experienced. Very atypical, and we'll ensure that this does not recur. So thank you. So, Mark, I'm going to switch the presentation back over now, and I'll wrap up the session here.
Thank you.
Thank you. Okay, so what's next? You can, as mentioned, access the webinar recordings on our YouTube channel, or just email us at education@scotiaitrade.com if you'd like to request a copy of the recording link. Now, today, after you exit the webinar session, a short survey is going to load in your web browser. Just ask if you take a few minutes and complete that, just so we know how we did today. And also, if you've got any other suggestions for useful webinar topics to be presented to you, we certainly appreciate. Oh, Mark, you might want to mute there. Yeah, we certainly will appreciate any suggestions that you may have for us. Thank you. Yeah, so going forward now, we have 2 additional webinars I'd like to mention to you on August the 10th, Thursday, August the 10th. A basic technical analysis session by the market guys will be presented, and that'll be for those who are just getting started on their investment journey. So welcome you to join up for that one. And also on August 22nd, the Montreal Exchange will be providing a session on option myths. For those of you who are interested in option trading, here's some useful information that will probably assist you in your trading. That's on August 22nd, option myths. Now you can go to our ScotiaITRADE.com website, click on the Education tab, click on then the events calendar, and from there you can register for any of the upcoming webinar sessions that you see there that might suit your fancy. So on behalf of Scotia iTrade and Client Education Department, I would like to thank Mark Noble for that amazing presentation, great information. I'd like to thank you as well for your patience and your time with us today. I do see some additional questions. Okay, great. Okay, just thank yous, some thank yous to Mark for that amazing presentation. Okay, so thank you once again, and we hope you have a really good day, and we look forward to seeing you again. As mentioned, I had already uploaded the presentation there for you, which you can then just click on the handout menu and download it to your computer. As mentioned again, if you want the presentation, recording of the presentation, just give me a quick email, and I'll send that out to you. Thank you so much. Have yourself a really great day. Take care.